Well, hello and welcome to Chapter 38. We're going to be talking about some other business organizational forms here for smaller businesses generally. You wouldn't see these, with pretty rare exceptions. Very large businesses would not be run in most of the formats we're going to talk about with this. So the first one that we're really going to look at is your limited liability companies. Now these are relatively recent, and this is somewhat worrisome. I think I've mentioned this for issues before for lawyers. We get very nervous with new structure. The reason for that is it becomes more difficult to answer questions. In many ways, the law is essentially a mechanism to predict the future. A client can come to me, ask me a question, can they do this, can they do that, what will the impact be in the future? And I can say, yes, it's legal, no, it's not, this is the way to do it, this is the way you shouldn't do it. But if something is newly created, there's not this body of case law that says this is how the courts interpret it, this is how it's structured. So limited liability companies make me a little nervous, which is not to say that people don't use them. Now, there is a uniform body of law, just like the Uniform Partnership Act, the corporations, and the UCC, and all these things. There is the Uniform Limited Liability Company Act, and we did adopt our own somewhat similar statute here in North Carolina in 2014. Now, when I say it's relatively new, it may not seem that way to those of you listening to this, because it was created in 1977, which is well within my adult lifetime. But for some of you, it was before you were born. In the terms of the law, though, 1977 is just a second in time. You have to remember that the common law that we still talk about and interpret today was created in medieval times, 600-700 years ago. So when you're talking about something that was created less than 40 years ago, that's a difference for us. It is taxed as a partnership, not a corporation, so that's again going to mean that it's a tax reporting entity, not a tax paying entity. In fact, now all unincorporated businesses are really presumed to be partnerships unless there's evidence to the contrary, and it is open to foreign ownership, and that term's somewhat elastic. Okay, what's the, let me back up to one issue here. I'm sorry. What's the nature of this? Well, as I said, an LLC is a legal entity. It is separate from its owners, like a corporation. And the people that own this, they're not shareholders, they're called members. Now, in some cases, LLCs, members can have some individual responsibility, some individual liability, but generally liability is limited for these. Like corporations, indeed like partnerships, you're going to have to file an organizational document with the Secretary of State. So the articles of organization are going to have basic information like what's its name, what's its address, critically, as I've talked about before, what's its registered agent, where that's the person that's going to take service. And by service, I mean when they service a process. When that agency, that LLC, gets sued, that's the person you send the documents to. Okay, now North Carolina LLC is found in Chapter 50D of the North Carolina General Statutes. And this is just kind of a hint, doesn't always apply, very often does. If you see an abbreviation in North Carolina which says 33C, 57D, if you see that Arabic numerals first, okay, like Chapter 14 is mainly the criminal law, Chapter 20 is mainly the motor vehicle law, that's great, but when you start to see 50D or 20D or 20C, that's going to be a later law. So 50D allows an operating agreement to be the controlling document, and we only use 57D, the North Carolina law that's adopted, if your operating document's unclear. And again, you have to file your operating document, your operating agreement, with the North Carolina Secretary of State's office. Jurisdictionally, if you've got total diversity of citizenship, then you can sue in federal court. But federal court's very expensive. Most of these cases are definitely going to wind up inside state court. Now, there are certain advantages and disadvantages to all these. Big advantage, your liability is limited to your investment. Your disadvantage, and it is a tax election. You can elect essentially partnership or corporation tax structure, and there can be different reasons for that at different times. Disadvantages, there's no uniform body of law in a lot of states, and this is true in North Carolina, so the law about these is different in North Carolina than it is in Wisconsin or Wyoming. And since it wasn't adopted, the revised vision wasn't adopted till about 6 years ago in North Carolina, there's not a lot of case law. Certainly not a lot of appellate law for us to look at. All right, so how do we manage these things? Well, you've really got two options. You either have member managed or manager managed. I know it's alliteration is a little rough there, but member managed is your presumptive form. Again, if your operating agreement says different, no, we're going to have a general manager or something, that's fine, but absent this, we're going to fall back on member management. The manager managed, who can be a member, has more obligations, more fiduciary duties. A lot of the time, as I said, and this goes back to quite a bit, that you have to both impress upon clients and impress upon you, is that operating a corporation or a partnership, you can vary a lot of the structure, you can vary a lot of the ways things are done by whatever is your document that controls it. So if you've got articles of corporation that say the head of the board will be called the praetor, and not the chairman of the board, that's fine, you can do it. If you wanted to say the vice president will have the power to make decisions, not the president, you can do that. But if you're silent, it's all going to fall under this Uniform Limited Liability Company Act. So you're going to have this operation agreement. Typically, this can be orally, and your book says that about so many things. But to be honest, it's very rare that something remains oral. Most of the time, we're going to have a written document. I can't imagine any attorney would let anybody operate for a while without reducing it to writing. I was just dealing with a quasi-legal issue with someone, and one of the best pieces of advice you're going to get at this is if you have an oral conversation that's important. So someone says to you, oh, I'm going to do this for you or that for you, or these are the conditions that we're going to agree on, and when you give me the money, you can have a very friendly relationship with them. That's great. But my advice to you is to send them an email saying, hey, that was good to talk to you. I'm glad we could agree that the price of it was going to be this and that you were going to deliver by this date. And what you're doing is you're creating a written reflection of your oral agreement. And this could clear up a real problem, because if this person gets it and says, no, we agreed on a different price or a different delivery time, he'll call you back and say, this isn't what we agreed upon, before you go through with this thing. Okay, absent any sort of agreement, we're going to look at partnership law. This is a sample of one of the more recent LLC agreements you can sign. Obviously, you can see this is just the first section of it. I couldn't include the entire thing for you to look at, but I thought you'd like to see a copy of the initial one. All right, so what are some of the common parts? Management, how are you going to do it? You're going to do it by members, you're going to do it by a manager. How are you going to divide up profits? Because remember, absent that, it's going to be partnership, and partnership generally means everybody gets an equal amount. Again, if you're contributing most of the money and most of the labor and you want most of the profits, you better spell it out. How do you transfer membership? That can be important. What happens when people disassociate? What are the requirements for formal meetings? How are you going to vote? Particularly the apportioning of votes. You're going to do it by capital investment, work. How are you going to do it? Sometimes, of course, these things don't work out and we're going to dissolve them. Dissolution is when partnerships or when LLCs want to break up. And when you dissolve, when you pull out, your duty of loyalty, such as it is, ends. It also ends any agency statute. You're no longer an agent for the LLC. You also may get, and this can be modified again by the operating agreement, a right to return any investment, your capital investment. And one of the things that's important is what we call that capital investment. Was it a loan? Was it a capital contribution? Do you have a call on a loan which says, yeah, I'm going to loan this LLC $50,000 and I'm going to invest $50,000. If I leave, the investment stays until they can reasonably pay me, but when I leave, my loan is due and payable. You could do that. Remaining members can vote to either continue or dissolve. Sometimes this is done via court order. They're going to make it dissolve, and that can certainly happen. You're going to have a reasonable time to wind it up, and pay off, particularly outside creditors. I'd like to emphasize that, again, I've said this several times, that when you're dealing with entities, you have to understand the capital structure of those entities in order not really to suffer unexpected loss. You've got to know who owes money that is being classified as a loan and who has invested money which is going to be classified as a capital investment. And that's going to affect how those people get paid. All right, there is some special business forms we'll talk about. We're going to first talk about joint ventures and then syndicates and a few others in a minute. A joint venture, usually two or more people get together for a single transaction. It is taxed usually like a partnership. It's treated under the law like a partnership, but it's not an ongoing business. So a joint venture, usually there's less apparent or implied authority. You might have a joint venture to, go look for a treasurership. That's fine. You got a joint venture. You find the joint venture, it's over. Duties are the same as a partnership, so you have major possibilities of conflict of interest. You got to be careful there. One of the things I recommend always: disclosure, disclosure, disclosure. Let everybody know what you're doing. Let everybody know who you're dealing with. Generally, under joint ventures, everybody's got an equal right of management as well. Syndicates are used when individuals get together, usually to finance a project. So usually a syndicate is more often an investment group. And they can take different forms. They can be corporations, even LLCs, I guess, or partnerships. Joint stock companies, they're not very common in North Carolina. I haven't seen a lot of these. It's a hybrid of a corporation and a partnership again. You're going to have shares of stock. You're going to have officers, directors, but owners are not treated as partners. But like a partnership, you form by agreement, not by statute. You hold property in the names of the members, not the joint stock company. And shareholders themselves, even though they're not agents, can have some personal liability here. And it's typically not seen as a separate entity. In many ways, I would say this combines, depending what you're doing, some of the worst possibilities. So that's why you don't tend to see a lot of joint stock companies. Business trusts. Now, trusts were once much more common. In fact, when we talk about, in the United States, antitrust legislation, which is designed to break up monopolies, and people say, well, why don't you break up a big monopoly, a big corporation like Microsoft or Amazon? And people refer to antitrust. It should occur to you, well, why are we talking trust here? Why aren't we talking anti-corporation? The reason is there were some laws that were structured really to restrict the concentration of capital. And one of the ways around that, around the turn of the last century, and I'm simplifying this, was to set up business trusts. So in a trust, legal ownership stays with the trustees and profits go to the beneficiaries. Business trusts really are corporate structures more than anything else. Again, not very common. Private trusts, much more common. Business trusts, don't tend to see them. Now, something you do tend to see, particularly in rural environments like North Carolina's sometimes, are cooperatives. They can be incorporated or not. Very often when a cooperative is incorporated, it's a nonprofit corporation. One of the things that will happen is, let's use an example, maybe not North Carolina, let's use orange juice growers in Florida. they might decide, all the growers, they might say, the people that are taking our orange juice and pulping it up and turning it into orange juice, they're making all the money. So what all our farmers should do is let's all contribute a little bit of money to create an orange juice squeezing plant. And we'll sell all our oranges to it. We'll squeeze it into orange juice there, and we'll take the profit in our farms. We won't take it in that business. It'll just be a non-profit. And the people that are the members, okay, will control it. They'll set it up, make sure it runs safely. So it's pretty common. And the nice thing about a co-op is it's exempt from some antitrust legislation. So it's one of the ways that you can have almost a monopoly in certain areas, but since it's usually a non-profit and there's people kind of underneath it, it tends to avoid some antitrust. All right, so what are some general considerations here? And we're going to hit this again when we're at the end of this sort of business organization series of chapters, is if a business is very successful, most businesses start as sole proprietorships. People get together, they start buying and selling stuff, making stuff, providing a service. If it doesn't go well, they stop. If it does go well, if it gets big enough that we want it to continue and expand, that's when we generally get to the point where we say there's enough issues here that we're going to take the next step. Maybe we're going to form a formal partnership. Maybe we're going to form an LLC. Maybe we're going to form a corporation. Maybe we're going to move from a corporation that's an S Corp to a corporation that's a C Corp. Now, the nice thing about the corporate model is the limited liability, although a lot of these other things we talked about have limited liability partnerships, limited liability corporate companies. A lot of them have, permutations of this. I will say that even if you have liability shield, insurance is necessary. It's not like you can say, well, I'm not going to worry about insurance because it's a corporation that's dealing it. That's not going to fly. Tax considerations, of course, is busy. Technically, if you're talking about a C corporation or a regular corporation, corporate taxation is double taxation. So the corporation earns money, suppose it earns $1 million, has $100,000 profit. On that profit, it pays, let's just make up a number, 20% tax. Okay, so now it has $80. It takes that $80 that's profit after it pays all its employees, and it distributes it as a dividend. So let's suppose you owned 100% of the corporation. You got $80. Well, you are an individual income taxpayer. Let's suppose that your maximum tax rate's 20%. You're going to pay $16 out of the $80 that was earned. But you'll notice that $1 million, you'll pay $160,000 out of the $800,000 that's distributed, if you want to look at it that way. So $1 million was earned. We paid $200,000 corporate tax. We distribute $800,000 dividends. You wind up paying $160,000. So if you combine those two taxes, if you look at it that way, you don't have to look at it that way. The effective tax rate was $360,000 or 36%, which is higher than the individual tax rate. So, for this only really becomes a consideration when you start making a lot of money, because most people, what they'll do is they will elect subchapter S status, which means you pay no taxes as a corporation. You avoid taxes completely, and you only are a tax reporting entity, and as you earn $1 million, great, you give it to the shareholders, business pays no tax. Now, there's some advantages here, because sometimes a company can do something. Let me give you a quick and dirty example, which isn't 100% accurate, but it's a way of thinking about it. Corporation can deduct health insurance that it pays for employees. So you form a corporation and you spend $10,000. Let's suppose you spend $100,000 on a great life insurance policy for all the employees in their family, and that employee is just you. Okay, well, tax deductible. Great, you're good. Now you don't pay any tax on it. But let's suppose that you pass that money through and you got that money as an individual, and you went out and bought life insurance or health insurance. That's not tax deductible. Now, it can be tax deductible over a certain percentage of your adjusted gross income, but you might not reach that threshold. So you might wind up, if you just pass it through, or if you don't have a corporate structure, you might wind up not being able to deduct your insurance policies, health insurance. Okay. LLCs can be a little bit expensive to form. Corporations can be a little expensive to form. There's all sorts of requirements, registration, licensing, taxes, health permits, zoning permits, import-export. All these become more difficult. The smaller the proprietorship, once it gets big enough, you really got to think about, is it just so big that we need a corporate structure as a more formal way of dealing with it? Sometimes we will convert these LLCs into corporations, typically when they get big enough. Now, one of the things that's important is intellectual property. There's I believe the man's name was Alvin Toffler, wrote a book called The Third Wave. And he said, look, there was one revolution, and the first revolution was agriculture. We went from a hunting-gathering society to an agricultural society. Great. Then right around 1700, 1750, there was the second great economic revolution, and that was the Industrial Revolution. We went from a society that most of its wealth was in land and food to most of its wealth was in stuff that we made, steel, simply. And he said, well, we're really in a third revolution, in which the third evolution is information. It's what's valuable. And if you think about something like Apple farms out its manufacturing. The manufacturing is interesting, great. You make the iPhone in Singapore, you make it in Malaysia, you make it in China, but those countries get pennies on the dollar. When that comes to the United States, it gets sold as an Apple phone. It's got value. Why does it have value? Because you're buying Apple. You wouldn't buy a Pear phone, right? So what's really valuable is that intellectual property, in particular the trademark, the service mark, the registration, whatever we're talking about here. So it's more difficult to protect that stuff as a small business. Now, it can be done. There's a very famous case. There's a guy here in Raleigh I bought my first personal computer from. His name was Nissan, Nissan. And he was actually an Arab American. And this was well before the internet. And as the internet was just kind of getting started, he applied for and got through ICANN the web address nissan.com. And of course, when it got big enough, the automobile company Nissan looked around and said, well, we want to register nissan.com. And it turns out, oh, wait a minute, this guy owns it. And they tried for years to get that away from him. And so it was really, really valuable. So these types of things can be more valuable than owning a steel mill, or more valuable than 100 bushels of wheat. So you do need to protect trade secrets and things like that. Things like non-disclosure agreements. Go ahead and change that. It shouldn't be secrets. It should be secrets. North Carolina regulates non-compete agreements. We don't allow them to be perpetual and eternal. We also talk about cause of action. Okay, the final point to really mention here is capital. One of the things is informal loans are pretty common to start up businesses. Sometimes you get a loan from your family or your friends. But once you get big enough, a bank wants more structure. Venture capitalists want more structure. One of the things they're going to want is they're going to want individual liability. You can say, well, I've got a corporation and I'd like to, make masks. Great. Your corporation will sign and you'll be the president of the corporation, but we want you to sign individually too. There are some crowdfunding that goes on, cooperative pooled funds based upon internet sites. Not a lot of regulation of this. Certainly doesn't get that big. Okay, well, that's pretty much an outline of Chapter 39, and whenever you're ready, we'll go on to Chapter 40. Have a good evening, afternoon, or morning.